really just talking about how consumer spending conditions have obviously softened quite markedly since September, and also taking the opportunity to mark some valuations given the peer basket has derated quite materially. The ASX 300 retail space down around 18% since the peak in August versus the ASX 300 down about 11%. So clearly some of that already been factored into share prices. Look, the main causes here are very well known to us. We do have a softening housing market in terms of prices and turnover activity. We've got volatility in the equity market, so those two combined dampen the wealth effect that has really buoyed us over the last 5 years, particularly in New South Wales. We do have political uncertainty. We've got 2 major elections next year, and also just spiking fuel prices, although they have rolled off materially since November, so easing the pain a little bit there. Look, elections worry us far less. They come and go every 3 years. They can defer business and consumer spending, but they are just a deferral. And then once you get that political certainty, it usually bounces back. So we're less concerned there. But clearly the softening housing market, is a major area of concern. I think, as we've talked about, I think low unemployment and low interest rates will soften the blow a little bit. But the Sydney housing prices are down 10% now from their peak to today. And, I think given this, most of the pain is being led by tightening credit and investors leaving the market, that can fall more over the next kind of 6 to 12 months. And Melbourne's down 6% as well. So just a little bit cautious there. One thing we talk about in the report is the rise of these online sale events, which have been around in the US for decades. They were kind of introduced here a couple of years ago, but the resounding feedback we're getting from retailers is that the traction from consumers on these November days like Click Frenzy, Black Friday, Cyber Monday has been extraordinary this year. So that's good in terms of it can smooth your Christmas spending over 2 months. But the problem is you don't actually know if it's a complete pull forward of Christmas demand earlier in the year as consumers really wait for these big sales events. So all retailers have to be involved or they risk losing market share, but obviously there are big discounts offered and so you lose margin early in the year than expected. So I think a lot of retailers sitting there at the moment with bated breath, kind of waiting to see, should they restock levels quite heavily in anticipation of Christmas, or have we already seen a big chunk of Christmas delivered in November? So that does bring about some higher earnings risk this year, particularly in regard to margins. But as I said, look, the sector has come off a lot. So arguably there's a lot of stocks trading on 8 times here. Arguably a lot of this is factored in, but I think we've come to know you get a downgrade, it's never quite factored in. So we've tried to be a bit more circumspect with our earnings forecasts out there. In terms of what we do like, and there are always some special situations out there, it's Lovisa around here. I still believe that February result, they can articulate all their pilot markets. So that's the US, that's Spain, and that's France, 3 very large markets. And if they articulate that, I think that can well and truly more than offset what perhaps might be a benign like-for-like sales update. Baby bunting, I've talked about that at length. We know what's going on there. And at the smaller end, Noni B, where you've got a pure cost-out story and a low-risk cost-out story really driving all your growth there.